On February 1st, 2025, the world economy felt a jolt, and it came from Washington. U.S. President Donald Trump announced a sweeping set of tariffs that hit not just one rival, but, multiple major trading partners at the same time. Canada and Mexico were slammed with a 25% tariff, and then came the real surprise, a new 10% tariff on Chinese goods, signed into law that same day. Markets were caught off guard. Analysts had expected tough talk about North American trade, but honestly, few imagined that China would be dragged into the fight in such a sudden and aggressive way. In just one stroke, Trump signaled that his administration was ready to challenge the world's second-largest economy head-on, reigniting a U.S.-China trade war many thought had cooled down in recent years. The move instantly raised questions. Why now? Why so broad? And what would China do next? What began as a trade policy announcement quickly became a global headline, the kind that makes stock markets twitch, currencies wobble, and business leaders start rethinking supply chains overnight. And in the middle of this shockwave, one thing became clear. This wasn't going to be a short, quiet dispute. This was the opening shot in a much larger economic battle. Trade wars don't just hit the companies directly involved. They ripple through entire supply chains, creating shockwaves in, some pretty unexpected places. Take the United States auto industry, for example. Even when an American car rolls off the assembly line in Michigan or Texas, a lot of its parts, especially batteries, electronics, and specialized materials, actually come from China or rely on Chinese processing. Replacing those parts isn't as simple as just picking a new supplier. It can take years to set up alternative production in places like India, Vietnam, or even within the United States itself. That's why China's 75% tariff isn't just a political gesture. It's a real cost driver. Higher import taxes mean higher production costs for U.S. manufacturers, and in industries with tight margins, those costs almost always get passed to the consumer. This is especially risky in the electric vehicle market, where battery costs are already one of the biggest challenges to keeping prices competitive. For everyday Americans, it could mean more expensive cars, longer wait times for deliveries, and even delays in green energy projects. For U.S. businesses, it creates uncertainty, a constant question of whether the parts they need will arrive on time and at a reasonable price. On the flip side, China will feel its own pain. Reduced access to the American market could mean falling export revenues and factory slowdowns, but Beijing is betting it can replace some of that demand by deepening trade ties with other regions, from Southeast Asia to Europe. The result is a kind of economic crossfire, where neither side escapes damage and the world supply chain takes the brunt of the hits. This clash between Washington and Beijing isn't happening in a vacuum. It's unfolding against a backdrop of global instability, and that's what makes it even more dangerous. Europe is still grappling with an energy crunch fueled by the Russia-Ukraine war. OPEC's oil decisions are sending shockwaves through fuel prices. Supply chains are still recovering from the pandemic's disruptions. Layer a U.S.-China trade war on top of that, and the risks multiply. The International Monetary Fund and World Bank have already warned that rising trade barriers could shave points off global economic growth. If the world's two largest economies keep escalating, the danger isn't just slower growth. It's a potential worldwide recession. There's also the political dimension. In the United States, Trump frames these tariffs as a promise kept to voters, a way to protect domestic jobs and industries from what he calls unfair Chinese competition. In China, President Xi Jinping's message is equally uncompromising. China will not bow to pressure and will defend its economic independence at all costs. That combination, high economic stakes and hard political positions, makes compromise harder. Both leaders want to show strength to their domestic audiences, even if it means prolonging the standoff. And because the United States and China together account for over a third of global GDP, whatever they do sends ripples or shockwaves across every continent. Right now, the trade war feels like a high-stakes poker game, and both players are holding their cards pretty close. Some analysts believe Trump's 10% tariff on Chinese goods is just the opening move, predicting it could rise to 20% across the board, or even 60% for certain Chinese products. Others think Beijing's 75% retaliation is a warning shot, and the real impact will depend on which items it chooses to target, whether it's just electric vehicles and tech products, or nearly everything coming from the United States. The uncertainty itself is a weapon. Businesses can't plan long-term investments if they don't know what the rules will be next month. Factories hesitate to expand, shipping companies change routes, and investors pull back, all of which can slow economic momentum. Could the two sides return to the negotiating table? History offers one example, the 2019 Phase 1 agreement, which eased some tensions. But this time, the ambitions are bigger and the gap wider. The United States is pushing friendshoring, building supply chains only with allies, while China is racing to achieve complete self-sufficiency in advanced tech like artificial intelligence, semiconductors, and autonomous vehicles. The longer the standoff lasts, the harder it will be to unwind. And the more each side invests in going it alone, the less incentive there will be to compromise. That's why many experts warn we might not be heading for a quick truce, but for a long-term economic divide between two rival systems. The United States-China trade clash is no longer just about tariffs or trade balances. It's about who will shape the future of global industry. From electric vehicles to semiconductors, from rare earths to green energy, both sides are fighting for control over the technologies and resources that will define the 21st century. But in this fight, there's a harsh reality. Trade wars rarely produce clear winners. Prices rise, supply chains break, growth slows, and ordinary people end up paying the price, whether it's in higher costs at the checkout counter or fewer job opportunities. If this standoff deepens, it could reshape the global economy for years. Countries caught in the middle will have to choose sides or scramble to adapt. Industries will be forced to rethink decades-old supply networks, and the risk of a global slowdown will hang over every decision policymakers make. The only question now is whether dialogue can still win out over confrontation. Will the United States and China find common ground, or will they harden into economic rivals locked in a permanent struggle? One thing is certain. The outcome will affect everyone, not just in Washington or Beijing, but in factories, markets, and households around the world. That's why it's crucial to stay informed and engaged. If you found this breakdown valuable, make sure to subscribe, follow our updates, and join the conversation in the comments. This story is still being written, and the next chapter could be even more dramatic.